We'll go ahead and get back to you guys in just a moment. We're going to go ahead and play a quick 14-minute video and then get the show rolling. All right, welcome everybody. Go ahead and get those questions into the comment boxes, chat boxes, so we can get your question answered. We'll go ahead and around the room here in just a moment, but a couple quick things. So we had a couple great calls today already, the WTF and then Wealth Wednesday webinar. So I see a lot of already familiar names and faces from those events. So I see some additional questions coming in from those ones. So if you guys haven't watched those, keep an eye out in the YouTube channel, Chris Nagel's YouTube channel for those when we put those in there. Shauna, when will those be available?
Wealth Wednesday webinar will be up Saturday. So Wednesday's live Zoom will be on the YouTube channel on Saturday every week.
Yeah, so if you guys didn't see that one, we did one on generational wealth and juvenile policies for generational wealth on Wednesday, Wealth Wednesday webinar. That was a really good one. So if you didn't see that one, go ahead and watch for that replay and check it out. A lot of great questions, a lot of back and forth on that one. Really fun call. So with that, we'll go ahead and go around the room. Sean, you want to kick it off?
Yeah, I'm here. I'm usually the one that reads the questions out to all these fine people who are always teaching me something new. So excited to have Joe on and Devin and Gabe and Brian today and see what we can do for you guys. So I'll pass it over to Gabe.
Hi, everyone. My name is Gabriel Ratana. I live in Newmarket, Maryland. Today, I'm at my farm with our newest members of our family. We got some sheep. It's one thing that it's like a new asset that I bought with my infinite banking policy. We bought a farm. It's also my permanent residence. So I live here. I own a jiu-jitsu school, and my family has a painting company. And I've been involved in real estate investing for a while. So I'm happy to help in any way I can. I'll pass it over to Devin.
Devin, can you hear us?
Am I muted?
Yep.
Can you guys hear me?
Good. Yep.
We got
All right, guys. So I am part of the team, been doing this for now almost 5 years. Started off as a client, used policies for infinite banking to do all my real estate deals and saw the power of it. So I started telling people. As people started learning it, they wanted to do it. I was sending everyone to Chris. And then it just hit me one day, like, why am I just sending this guy all this free business? Why don't I be him and set the policies up? So got licensed March of 2021 and just excited to help. Excited to help you guys understand this better. Once you understand it, it is the Swiss Army knife of finances.
Down to you, Joe.
To me, I'm Joe. I'm up in Buffalo with Shauna and Chris. I started with Chris back in 2018. Started IBC in 2019. Joined the team in 2020. So here with Bree. She's on my team now, and we're here helping people solve problems and answering questions and climbing the ladder of wealth. So get those questions in. Brianna can be next.
Hello, I'm Brianna, or Brie like the cheese, and I'm up here thawing in Alaska for spring. I started IBC in March of 2022, just celebrated my 3rd year. It took 8 months for me to get out of debt, and as soon as I saw the power of IBC, just like Devin, I was like, I need to get licensed and start helping people, and then I joined Joe a year ago, and I've been his warden ever since. So we're here to get you on the books and help answer any questions we can. So bring them in.
Awesome. All right, let's dive on in.
All right. This one looks like it's for you, Joe. So Jay Bonehead says, first lien HELOC question. When applying, if between myself and I and our debt to income ratio is 30%, but she has a credit of 650 and I have a credit of 820, would we be eligible for a first lien based on those scores?
The 650, no, if both of you are going in together. If you both need both of your incomes in order to qualify, it is a 45% DTI. We would have to get her credit score up to 700, and then it would be a go. if you would qualify with your income alone for the 85% LTV, then we can just use you. But if we need both of them, both of you guys, then we're going to have to get that credit score up to 700.
Okay, cool. Shane is saying, great Wealth Wednesday today got me thinking. If I have a total of $3 million in insurance, then I should be able to do at least 1.5 million on each child, or is it a total of 1.5 million between them?
Great
1.5 on each. Yes,
That's awesome.
Yeah. So.
All right. OJ saying, question about using policy loan to purchase a vehicle. What strategy is used if your policy doesn't have enough cash value to purchase the whole vehicle outright? Do you just do a large down payment?
Ooh, I just bought a car 2 weeks ago and I didn't have all the cash value in. I'm still going to be contributing to the policy and running the money through and recapturing what's going towards the vehicle in that sense. So I did get financing, but I know I can get the arbitrage, have the dollars working elsewhere with what I'm doing with the home equity. So it made sense not to just do a lump sum all at once. I would rather put 25, 30,000 to an investment than pay for it outright for the car when I know I can make the spread like a bank.
Yeah. So to be honest, I mean, OJ, it depends. You know, it depends on your situation. I mean, you could just pay the entire amount. If you had all the cash value, you could pay it in the car. But yeah, as Bree's saying, you can take that money and put it to work for you. Now, keep it in mind when you're doing that, you're adding another kind of ingredient to the whole equation here. So you've got to understand the pros and cons, risks and rewards of what you're putting your money into. Be careful with that. But yeah, I mean, now what you have though, what Bree's doing is you have an asset paying for your liability. That's the golden goose right there. So when I was working with a lot of advisors and mentors and wealthy individuals, they would never just get a liability and then end it right there. That's not what they would do. They would say, hey, if I have capital to put to work or it's OPM, I'm going to put it to work first so I have an asset or asset cash flow, as I call it, and then that pays the liability. And then essentially you're zero out of pocket potentially. So, yeah. But once again, there's a few more moving parts in that though. That's why not everybody does it.
Spend interest, not principal.
There you go. Yeah.
Every situation is different, though.
Yeah. Math.
It's math. That's right.
Derek Olson is saying, how do you make more money what is everyone's career field?
I mean, that's an individual answer right there. There's so many things on that one. But I'll share something. So when I was running one of my education businesses, I did a mini course on how to ask for a raise when you have a W-2 job or an employer. And that lesson got so many comments because everybody thinks that, I got to go ask for a raise. It's just that simple. No, it's not. There's a whole strategic formula to asking for a raise. What day do you do it? How do you do it? Do you deserve it? I mean, there's all these things, but a lot of people loved it because when I had a W-2 job and career, I got raises quite often, but I did them very strategically. And so I was paid very well. I did not work very hard, I'll be honest, in that career. I didn't like it, but I didn't work very hard, but I was very highly paid because I was very strategic on how I got raises. So that's one way right there is can you get more for what you're already doing? Like that's number one. Don't work harder, right? Just can you get more income based on what you're currently doing? Then, of course, there's a whole multitude of answers to how you make more money going and doing other things. Joe can attest to that.
I was going to say my thing is thinking about how do you make more money. I don't want to think about, I need or want money for this. How can I go get a job or how can I put in more work to make the money? It's always what opportunities can I find to put the money to work to make more money. That's the goal. That's why we're here, BYOB.
Yep, absolutely.
I retired 8 years ago. What's my career field? Investor, entrepreneur,
philanthropist.
My career field is, I guess, I'd say infinite banking.
Banking. That's a good one.
I can share. I started going down like the real estate investing rabbit hole. First, I started kind of by accident. After college, I moved to Miami and I bought just a 1 bedroom condo. I actually got a loan from my dad, so we started practicing like family banking, uh, without even knowing kind of anything about infinite banking. And I figured it'd be better to own than rent. Um,
I am a robot.
Yeah,
Yeah,
we're
you went
losing.
robot.
We're losing you, Gabe.
It was legacy. Oh, you losing me?
You're back in. You're back in.
Yeah.
I'll go in.
Need a router to go pin.
Ended up paying for a really expensive coaching program with it was like a Robert Kiyosaki one. Went in with my dad to try to learn how to get into real estate, and we started flipping houses, but we started to see the people making all the money were the contractors and the lenders. So we have a painting business and we do new construction apartments. So we decided to focus on that. But what's nice about infinite banking, if you read the book and becoming your own banker, and you understand the grocery store example, if you're able to run your money through policies, then you have a business that's maybe boring but dependable. You can end up just capturing all the cash flow and using that to grow your wealth. So after the real estate investing, I decided to focus on I kind of cashed out all my properties and put that into jujitsu, open up a school. So now for me to make more money, I need more students. So I invest into marketing to grow the school, delivering a good experience for people. But in my opinion, I think it's building a business where you can solve someone's problem, create value for people, and make active income. Then you can use that money to do the things that Joe does.
Well, Zig Ziglar says it best: solve enough people's problems, your problems get solved in turn. So find out problems you can solve.
Mm-hmm.
I love it. And I like what you said, Brian, about knowing when to ask for a raise. My mindset has always kind of been, I think Earl Nightingale says it too, is you always give more value than you are even being paid for. And that has served me well throughout my whole life. I always feel like I'm probably giving more value than what I've earned, but it's taken me a lot farther. So I'm happy.
Yeah. One time, I was doing more than I was asked to do. And then I got asked to go to Louisiana during the middle of the last recession. So in 2009 or 10, when everybody was getting fired and people in my industry, construction industry, people were losing their jobs left and right. I was getting paid 30% more than everybody else because I showed the value, and two, I stepped up and said, hey, everybody said, hey, there's an opportunity, but you got to move. I was like, yep, me right here. And because of that, I made a lot more money. So yeah.
I love it. Jeremy is saying, when using the IBC, do you have access to a card to use the money taken out, or is it one lump sum? So maybe we'll just explain the fundamentals of that.
I'd love it if they had a card to take cash value out. That'd be amazing. But no, they don't, not yet. I know there's some people that are potentially working on that through blockchain stuff, but no. Currently, the only thing that does that is mainly a HELOC. That when you bought, or a credit card, of course, but yeah, it's a lump sum, and typically I believe it's $1,000 minimum is what they prefer you to take out. They don't like you taking out less than that usually. Does anybody had any clients that are taking out less than that? I think someone said yes, they do.
I started my first policy with just a few hundred as a monthly premium because I didn't know what I was doing as a client when I started. And it was with a different company, of course. So, as soon as that payment hit in the first week, I'm like, yoink, man, immediately took a loan for 165. So 173 with the interest taken off the top.
Nice.
But it's a dashboard. You just go into the dashboard for your insurance company, take a loan, and then that will get deposited usually within 2 to 3 days right to the checking account, and then you can utilize it.
Absolutely. Okay. Herminio is saying, if I get a policy, can you explain if you choose to pay for additional PUAs? Just wondering, does it affect the policy? And then how does it affect the policy?
Let's see, if you get a policy.
When you
That's kind of a
pay
good
for,
question. That's a good question, actually. If I understand what he's asking, is if it's so first off, it has to be built to have the additional PUAs built into it. So you have to build it
True.
correctly first. But it depends on who sets it up and how they educate you. So unfortunately, I've had come across clients where they have the policy's built to allow 10,000 to go in as an example, but they're sold on the premium being only 3,000. Oh, I'm putting in 3,000, but you have the option to put in an additional 7,000. We don't really talk that way. We say that no, the premium is $10,000. That's what you want to put in. Some other people will sell you on the low premium of 3,000. Oh, but if you want, you can put in 10. But that's not true infinite banking, because if you don't put in the 10, you're not funding your policy. You're not funding your bank. And I've had
And
a
that's
lot of
my
those calls.
first policy.
Yeah, I've had a lot of those calls, by the way. And they call me up and they say, I heard you talk, Brian. I heard someone else talk on your team. And they're saying, hey, I'm doing this, but I don't have cash value. I have very little. I don't understand it. What's going on? I'm like, what do you, and they keep saying, but my premium is $3,000. I'm like, no, it's not. That's your minimum to keep the policy active and alive. What you want to be putting in is a 10,000. They're like, but I can't afford 10,000. You got sold a pile of crap. That
Yep.
agent took advantage of that person. And I've had that happen quite a few times, or talked to somebody. And so what they did is they sold you on the premium. They got a higher premium base on the 3,000, meaning they got a more commission. So unfortunately, it does happen. But so to answer your question, it's built for the full amount that you want to put in, including PUAs. If you want to put in additional amounts above that, that's called a dump in, things like that. We can build those, and then you can build policies where you have the option but not the obligation for more PUAs in after year one. But once again, why? What are we solving? What are we trying to overcome here with you? Build the policy to do that first.
The PUA is the banking aspect of the policy. The minimum would be the base.
Yeah.
You get your dividends and interest from the deposit in the PUAs. And that is what you're able to borrow and utilize.
That did
Love
make
it.
sense. Yeah. Just let us know.
That's something that would be good for on one of your calls with a mentor. And then so I kind of put it at the bottom of the screen too. So mentors.beyourownbanker.com is our calendar link there. David is saying a question mostly for Joe. Is there a kind of minimum amount to do a first lien HELOC to buy a property?
Probably the
85
minimum down.
85%, 15% down to purchase a property, just like a mortgage. If you were to do conventional way, it would be a 20/80. With a HELOC, it's a 15/85, and there is no PMI or anything like that. It's not like an FHA where you have to pay extra with PMI. The base would be a 15% down, 85% LTV on the purchase of the house.
All right. Deborah's just looking for some advice. She said, I'm trying to start getting into a better place with my finances by going back to work after not working for almost 20 years. I was injured in the line of duty, got very ill. My dilemma now is buying a car to get the job, and her income was cut and her credit is poor. So she's been trying to rebuild her credit. So any advice or anything there?
I mean, I've done it before back in the day when I had really bad credit and stuff, and I just went to one of those car companies that gives you a loan, and I got a car, and I needed that. But I didn't like the loan. It wasn't really bad or anything, but I needed the car to generate income, sort of like you. So it worked. So just whatever the best vehicle is for your situation is what I would say, and then of course I got out of that. I paid it off very quickly. Once I got rid of that loan. So, but that was way before infinite banking and all this kind of stuff existed in my life.
My first few cars were death traps because I couldn't. Dealerships weren't an option. Turning, you got to hold the door shut so it doesn't go flying open.
Remember in college one time, my 68 Ford Fairlane station wagon went over a bump and the exhaust muffler fell off the back end. We kept right on going. sounded a bit different after that, though. A little bit louder.
Oh, you guys are funny.
Ford Fairlane. Nice.
Yeah. A station wagon, by the way.
Nice.
Yeah. It was awesome. I wish I hadn't gotten rid of it because I had the tailgate that would open up like a truck bed or it would swing open too. It was actually a rare car, but had no paint.
Trying to be like the Dice Man.
Oh, yeah. It was sketchy.
Justin saying, hypothetically, if you have a 0% interest loan for 18 months, would you keep it like that or use your policy to pay it off, since when you're paying the policy back, you're paying yourself with interest and principal?
It depends.
It depends. On me, I think I'd leave it, but I don't know.
Well, I mean, it depends on what other things you got going on. Do you have other debts, other things? Because if that's 0%, it's not costing you anything. Take that money, put it somewhere else where it's more valuable for you. If you have other debts that have interest, I'd put it there first. Or if you can put that money to work in a cash flowing strategy, that would also be good too, because then you could accelerate that debt payoff. And then at 18 months, then you could pay it off if the interest is going to come in and be high. But once again, that would be a strategy call right there, Justin.
Yeah, put it somewhere to make you more money, and then in 18 months, pay it off.
That's his only debt, just his house, other things. So, yeah, I mean, you could if you know what to a good place to put it to work for you, by all means, look at that as an option in the meantime.
All right. Kathleen is saying, how many policies do each of you own, and when do you know when it's time to get subsequent policies? This is a lovely question.
Mm-hmm.
There you go, Devin.
We'll start with Devin.
Sorry, guys. I'm like multitasking. The question
How
was
many-
how many policies, and when do you know when to get a new one?
Yes.
Yeah.
I have 15 policies. 4 on me, 3 on my wife, 3 on my oldest daughter, 1 on my younger, 1 on my parents, 1 on my in-laws. So when you get a new one, is basically when you've put everything into the premiums of the ones you have before. Like, let's say I've got 1 policy, I've put in 10 grand. That's my limit. That's the base and the PUAs. And my premiums aren't due for another 8 months, 9 months, whatever it is. And I've got extra money that's just sitting, being lazy in my bank account or somewhere else where it's not doing anything for me. I've got to wait 8 months until I can put in another 10 grand. So at that point, that's when I'd want to start a new policy to get that money into the compound interest and get it protected against the lawsuits and judgments. And if I'm closer to my premiums being due, so if I'm like a month away, 2 months away, maybe, I'm not going to go get a new policy because I got to fund that next one with 10 grand. So it depends on when your premiums are due, how much you have extra that hasn't been put through premiums first. And it just kind of depends on your cash flow. So that's my answer for you guys.
Yep.
By the end of this year, I think I'll have 5. So
I've got 2 on me, working on a second one for my hubby, working on my brother's in underwriting right now for his, got my little brother working on one. My parents are slowly turning over to the side with the facts. So they're coming around to getting their appointments going.
I'm at 4, so I'm definitely ready for another one.
I have 2 on me, and there's 1 on my son, but my dad owns it. So for that one, we've been talking about child policies today. We got one made. My dad asked me, where's the best place to put money for his grandson, my son, so that once he's 18 and he wants to go to college, he can be fully paid. So obviously we went with an infinite banking policy. We designed it. It's a great policy. We started a couple months after he was born. So there's 3 on us, and then soon to get 1 on Amy, my partner, and then we got a bunch of kids, so we're eventually going to have more.
I want to answer Kathleen's policy per the IRS guidelines, though. Depending, it's not how many policies you have, it's how much money are you running through the policies that you have. Somebody could have 10 policies and be running 100,000 through all 10. One person can have one policy running 100,000 through that one policy. So it's really up to your income. The guideline states that 25% of your gross annual income can be run through life insurance policies. So if you're making 100,000 a year, the rule says 25,000 can run through policies. If you're only running 5,000 or 10,000 through the policy, well, you still have room for another 15,000 to run through. So if you want to be at the maximum per the guidelines, and there's a reason why they put a cap of 25% on. Back in the 80s, all the rich people were taking money and stuffing it inside of these policies, and the IRS said, we have to make a rule because we're not going to get taxes on any of this money. So if you want to be efficient and utilize everything, 25% of your annual gross income would be the limit to where you would want to be at.
And R. Nelson Nash says the average person will take 15 to 20 years to get 100% of their premium to equal their income. And that's kind of the goal. We're capturing 100% of what we're bringing in, and we're keeping it in a vehicle where we're going to be benefiting from it for our family, ideally for generations to come. And we should always be able to get more policies if we're playing correctly, because we're here to keep increasing that income passively, but increasing nonetheless.
I have 2 policies on myself, 1 on my daughter, and I always think about getting another one here soon. And for the first time, I thought about possibly getting it on my mother, and then having me be the beneficiary of that one too. So that would be next. And I was talking to Craig about it, and she only makes like about $65,000 a year. So I could probably, according to Craig, do like a $9,000 to $13,000 policy with that. So that's just whenever I can afford to do $9,000 to $13,000 on top of all the other policies that I have right now. That's my next train of thought.
Shauna, get that policy ASAP.
Yeah.
ASAP. I got policies, like I said, guys, on my parents and my in-laws. As soon as I could, the thought hit me in the shower. Funny enough, all my best thoughts are in the shower, just so you guys know. So I'm like, you know what? I love my parents to death, but they're probably gonna pass away in 10, 15 years. They're approaching their 70s, right? So I'm like, you know what? How about I insure them? They're gonna die at some point. I can use the cash value now. I use it to give them a retirement income. So I pay them so they can be retired. It's tax-free. They don't have to pay me back. When they pass away, the death benefit pays off all those loans I gave them. And then the surplus, the difference, goes to my trust, which buys more policies on my kids, my wife, me. So you guys want to look at it. Sean, I would definitely recommend doing it. Everyone that's listening, look at it like everyone in your family, everyone that's close to you, business partners, whatever, they're going to die at some point. So ensure that guaranteed event. And when it happens, tax-free money comes to you or your trust or whatever. And then you can use that tax-free money to fund more policies that grow tax-free. So it's a huge play. And especially if they're getting older, you want to make sure you get it before they're uninsurable.
I like that. I really truly only thought about it like 2 days ago, and the thought never crossed my mind, but I was reading What Would the Rockefellers Do by Garrett Gunderson, and he kind of put it like, everyone works their whole life to make a net worth, and basically buying whole life is like buying your net worth. Essentially, you're buying that death benefit. And I know how I'm doing that for my daughter, but I'm like, it would be really nice if my mom had a policy and I could benefit from that for a period of time. So cool. I will. Thanks, Devin. Derek is saying, I'm buying a home. Once my finances stabilize, how much is an average amount to add to an infinite banking policy? Do you recommend a percentage of your cash flow?
Well, I want to know
Why
how
we're
you're
making the
buying the
policy.
house.
I was going
Are we
to
going to
say,
get a mortgage and let the bank be in control, or are we going to buy it with a HELOC and you be in control? Why would you want to pay amortization when you can pay simple interest and be in control of it?
But we also need to know what the policy is being made for, and that's going to determine how much we would want to be running through as cash flow. And we still have that limit up to 25% of the income can be run through as premium.
What are we going to utilize the policy for? What problem are we solving? What are we going to benefit for running the money through, and how are we going to use the money once it goes in?
Can we hit on that real quick? I know we always say the phrase, like, what are we solving? And I think we do a super good job of saying, like, what infinite banking is and how much we love it and why you should put your money there. And some people don't even know what problem they want to solve, but they know they want the bank that we keep saying. So like me in the beginning, when I was funding my policies, they weren't big at all. And I didn't know what to do with them at first until Andrew on our team was like, you go to Disneyland, just use that for your Disneyland trips, that you take every year right now until it's big enough for you to privately lend. So sometimes I think we don't, like, our audience knows they want to do this, but they don't know what problem they want to solve, but they know they want a policy.
I went through that cycle of debt and paycheck to paycheck quite a bit. Windfalls would come in and then things would be back to where they were. So I needed to get in control, and I needed to, maybe you guys have experienced it, where you're paying your bills, you're working hard, the money's coming in, you pay the bills, you save what's left. And you notice it's not always as much as you were hoping or needing to like keep on your goals. So you save what you can. And then an unexpected expense comes in and you're like, shoot, I don't have the money. I don't want to go into debt for this. I mean, I have it here in my savings, so I guess I can use it. And then you use it and you lose it. Now the savings are gone. We're having to replenish it and rebuild. And I just kept in that cycle until I got IBC started and started capturing my money in my policy and then using the life insurance company's dollars to pay off the debt, and saw that happening, that I was actually saving what I could. I was using my debts and expenses to create my savings. The savings keeps going up, and it'll never be in that situation again where I'll always be able to leverage, not use and lose. So that was a kind of a consideration. If there's debt, that should be first and foremost what a lot of people are needing to tackle. Especially if you're considering investing. Do you have debt? Then we should probably look at tackling the debt before we invest for a 12% return when we have a 30% credit card. So, yes, there's all kinds of problems. Or like we're talking about generational wealth, legacy protection. You're trying to build up kids policies. You're trying to put your kids in a better position than you were and get, some of those things started for them. Maybe you don't want to put in a lot of funds. So it's just that little bit of spending money or what have you, an allowance. That's what I did for my stepson. So.
don't you go dine on us now.
I work him like a dog, Brian. You know how it is.
Okay, Jay is saying, I would like your guys' opinion on what I could do with my 403B in a year and a half when I'm 59 and a half. And then he said, I'm not yelling, I've just put my question in all caps.
Not financial advice.
Yes.
Well, I mean, the best person to talk to is a tax professional about that, because that's what's going to happen is taxes. When you're 59 and a half, if I understand the 403B correctly, yeah, you can take it out without the penalty, but it's going to have a tax consequence, and the amount you take could change your tax level, or your amount. So you just got to be careful about what you do. You can always roll it over to another qualified plan that you control, like a self-directed IRA, something like that, or something like that. But once again, it depends on what you're going to want to accomplish with it. Depends on what you're trying to overcome. That's the answer. Then once you know the answer, then you can look at the options that you can do with the 403B.
Always think about what you're doing with the money. Think about what boxes you need to check. Does the money need to be accessible? Does the money need to not have a penalty? Does the money not need to be taxed? Whatever the cases are, you need to look at your boxes and then kind of compare. What is this specific financial product? What is this vehicle? What is this? And does it check those boxes? Because if it doesn't, no point entertaining it.
What I would do, and this is what I would do, this is not financial advice. This is what I would do. So you want to look at your tax bracket, and Brian briefly kind of touched on this. Most people, a lot of people don't know that we're in a bracketed system. Like even my dad, he's like 70 years old. He did not understand that if you're in like, let's say 37% tax bracket, you're only in that bracket for the income in that bracket. Everything else is at a lower bracket, so on and so forth. So what I would do is look at how far away you are from the next bracket. And whatever that is, let's say it's 20 grand. Take from that 403B up to that next bracket without going over, because then you'll be taxed more on the overage. And then next year, you can do the same thing. At the end of the year, let's say you're 30 grand away from that next bracket. Take another 30 out. So you're not upping your brackets. That's what I would personally do. And just whoever your CPA is can tell you, hey, you've got this much until you're at that next bracket, or you can look them up. You can Google tax brackets. So that's what I would do, not financial advice.
I had a disclaimer on the bottom of the screen the whole time too, so we're safe. But honestly, Devin, I didn't know that until you just shared that with me. I didn't know that's how it worked.
Yeah, really, because I've talked to people, you know, and they, well, I don't know about my tax bracket. I says, but you're only going to pay like $50 because you went to that next tax bracket. You still stayed in that 18 just because you jumped up to the 23. It's not the other 68,000 that you pay it on. It's just that 1,000 that you jumped into the next tax bracket. People do, Devin. People just don't understand that.
I genuinely am right now. I'm just understanding that. So thank you guys.
Yeah.
All right. Derek Olson is saying, should you refinance a home into a HELOC to work on paying the home off ASAP using Velocity Banking?
Yes.
That sounds like a great idea, Derek.
I'm glad you thought of it.
And then he did do a couple more follow-ups. He says, I have to buy it with a mortgage to get our foot in the door. We're using a first-time home buyer's grant to use as a down payment. I wouldn't be able to get a HELOC this year, and we shouldn't wait until we have 15% down to get a HELOC we're underwriting right now. So I guess
Back that up again. Let me see the other one.
so using it with a mortgage to secure the house right now, like just to get
Because
it.
we're getting a first-time home buyer's grant.
So you're getting an FHA loan because you're only putting down X amount, not 20%. If it is an FHA loan, you're going to pay PMI, and FHA keeps that PMI on forever, even after you get past your 20%, your 30%, and 50%. You need, as soon as you get 20% or even 15%, if you're going to flip it into an all-in-one, to get out of that FHA as soon as you possibly can, to not be giving PMI just an extra bill, lighting an extra $125 or whatever on fire every month.
There are some banks that go to 90, 95%. It really depends. It depends on the location. It depends on the amount, like the value of the home and how much the line of credit's going to be for. But there are ways to get higher than the normal 80 to 85% range.
Depends what your state you're into.
Yes, yep. Where you're at, all that. I got my house at the end of 2023. We closed on Halloween of 23, moved in November. We paid for the mortgage for 14 months. That was $3,000 a month. We had amortization. We had our escrow. We had all the fun things that come with a mortgage. $42,000 later, we had only reduced the principal by a couple thousand. So that didn't really help us, add more to the equity for us to be likely to get the HELOC. We were able to do it because we put down enough. So when we got our HELOC this year, we were able to do a lot more towards the principal, 3 times what we put in a year in the mortgage, just in the first month with the HELOC. So I would exhaust all options for the HELOC before looking at a mortgage, unless it's putting the house at risk. And then I totally understand wanting to get into a home, because I did the same thing. It's just, remember, you're going to have those additional costs of what's going to interest, what's going to PMI, what's going to escrow, that's going to be keeping you from getting to that amount in equity as fast as you might like.
And usually the seasoning is about 6 months after you get into a mortgage to flip it into a HELOC or changing it.
All right, and can we roll right into this one? So Knights of Israel saying, can I get a rundown on how Joe's HELOC running all your income into this HELOC concept?
I have a picture.
You got it? Can you throw that up or no?
I don't know.
So it's the one pot system. The HELOC is the operating account. It's the nucleus. It's your savings account, your investment account. It's your checking account. Any penny that comes into the house goes into the HELOC. A HELOC interest is based on the average daily balance over the course of the month, the 30 days. So if you're getting paid, like say on the calendar every week, on the 7th, $1,000 goes into the HELOC, on the 14th, on the 21st, on the 28th, you just decrease the principal by $4,000. Now you have to pay for the HELOC. You have to pay your credit card and all your monthly bills. So you do that on the 29th and the 30th. So what did you do for 28 days? You decreased the principal amount for 28 days. And that is how the interest is calculated. You only increased it on 2 of the days. So it's the daily average balance. And that is how it's calculated from the bank and how much interest you actually pay per the month. So that's utilizing velocity and the HELOC as the one pot system for all the money going into the one pot, utilizing velocity, playing a trick with the algorithm for the interest that has to get paid to the bank.
I have the image there if you want to show it.
Oh, cool. How do we do that? Nice.
There it is. So that's the HELOC as the nucleus. That's the savings account, the checking account, the investment account. Every month you got to pay your bills, comes out of the HELOC. The HELOC pays the HELOC payment. Your W-2 comes in, your rental income comes in, your interest comes in from your investments. So we take the HELOC, run it through the policy if it's on a monthly basis, and then as soon as the cash value is there, where does it go? Back into the HELOC so that we can utilize it. The policy is an asset. The HELOC is technically not an asset until you put the money to work and make more money, just like your house. Your house is a liability until you get a HELOC and turn it into an asset by having your investments pay for you to live in your house. So money goes into the HELOC, run it through the policy, put it into the investment or your opportunity to make more money, and then everything flows right back into the HELOC.
And then Joe, I just remember, I had to hear this from you multiple times before I really understood it. And the reason why, like your savings and checking and everything, because when that does go in the HELOC, then your true savings and checking account reads $0 because your money's in your HELOC, and some people are confused by that, or like it's a little off-putting feeling. But the reason that I learned from you guys is why you want it in the HELOC is because every night that interest on the balance is determined or something. So the more you want as much money in the HELOC as possible at the end of the night so that your little daily interest bill is as low as possible.
Exactly.
Okay. I'm learning.
So like say somebody says, I have a HELOC, but I don't owe too much on it. I only owe $20,000. I'll say, well, do you have a savings account? Yeah, of course I have a savings account. How much is in the savings account? Oh, $10,000. Okay, so how much is that $10,000 making you in the savings account? Oh, pennies, 0.01%. How much is the HELOC costing you to use? 8%. So you have $10,000 in a savings account making 0.0 while you have that money. Why do you pay 8% on that 10,000 when you can take your savings account, put it inside the HELOC, save yourself 8% on $10,000 a month, and it's still accessible, as easy as a savings account. It's right there. It's revolving. You can put money in on Monday, take it out on Tuesday. Put money in on Wednesday, take it out on Thursday.
And people kind of get that when they get stuck with debt, like trying to pay off credit cards and the like. They understand credit cards being a revolving line of credit, and they have the amount owed and they can't pay it all off, but they pay more than the minimum and know that that's kind of like takes it out of everything else. But it's like, okay, we reduced it. Yeah, but you did it because you know you're paying interest on the dollars that are being utilized. Same thing. So, yeah.
I hope that answered your question.
I think it did. Christian is saying, hey, Joe and Bree, so if I qualify for a HELOC, would you buy a house or put it in logistics to earn more money than buy a home?
So if I qualify for a HELOC, would you buy a house?
Or put it to work?
You mean like
do you,
have?
Do you need a house to live in?
Yeah, probably.
I guess I don't understand the question. Like if you're renting and you have a 20% down, would you put that into an opportunity and instead of buying the house? I guess I don't understand the question.
You have to have a house to have a HELOC.
Right.
Well, you can you can buy a house with a HELOC. So if that's what they're talking about, like they're qualified for the HELOC and they want to buy a house, then by all means buy the house with the HELOC. But putting it in logistics to earn more money, do we need more money? Like, is that it's not a consideration for the HELOC?
Yeah. Christian, do a different question.
Okay, and then we have 10 minutes left, and we do have some questions, not a ton, but we'll try to rifle through them a little bit quicker. So RJ saying, if I buy a policy on my parents, am I the owner and the beneficiary, and parents are the insured, and I control the cash value?
Sure.
You can be, yes.
Okay. Matthew is saying, do you guys operate in Canada?
You have people who can.
Yep. Email, we'll have you email Snaggy, snaggy@chrisnovel.com, and say that you are looking to connect with somebody in Canada.
Holy cow. 4 different messages at once.
Anna is saying, can you get a policy on a parent even if they potentially have another non-IBC policy?
Yeah, potentially.
Yes.
Depends on their human life value and how much room they have on insurance for insurability.
Okay, good job, guys. We're getting through them. Derek Olson is saying, would I be able to use a second lien HELOC to pay down the mortgage faster to work towards getting a first lien HELOC?
Yes, that's how I started. I started with 175, then moved to 400, then moved to 750. It just depends. I mean, we can have a strategy call and we can kind of figure out what you need to do and how to do it. You can actually use that second lien as the one pot system also.
Mm-hmm.
What you guys can do, this is actually what I'm doing currently because of how my taxes work. I have so many write-offs. I can't actually qualify for a first lien HELOC. So I've got a 2.875 on my mortgage, super low rate, right? But it's amortized. So I end up paying a ton of interest if that goes through for 30 years. And I've got an equity line, HELOC, I'm using that HELOC to pay down the first mortgage in lump sums. So what happens is I can pay that down, and this is super important. Once it's paid down in a lump sum, I do what's called a recast, RECAST, recast. So I call the mortgage company, the first lien, ask them to recast the mortgage, which means they will reduce the payment based on the new balance with the same terms, 2.875, X amount of years left. So now I just reduced my first mortgage payment. That extra money I can put towards the HELOC to build that up faster, to pay down the first mortgage again. So hopefully that makes sense. I didn't lose you guys, but that's what I'm currently doing with my second lien to pay off my first lien.
Now, I had a bank that would do that, but the other bank wouldn't. So does it depend by banks also?
The recast?
Yeah.
Oh,
Oh, we
easy
lost
come,
Devin.
easy go. I would
No,
think so. If your bank wouldn't do
There
it,
it
but
is.
his did.
You guys hear me?
Yes, here you
you're
go.
back. You're back. We got you.
You guys there?
Yeah.
Yeah.
All right. I had a call come in, so it was
Oh.
that was weird. But I used to work for Rocket Mortgage. They would do a recast, and it was like $100. So
Okay.
I guess it depends on the bank. That's who we have for our first mortgage is Rocket Mortgage. So they do it, and I know that there's a minimum of
10,000? 10 months? 10
10,000.
years?
10 what?
We're left holding.
I need to put my phone on do not disturb.
we
All right.
lost you. We lost you at 10.
Yeah, they have a minimum that you have to put at least 10 grand down on the recast for it to work. So you can't like put $1,000 and have them recast it. But we're doing like lump sums, like 200-300 grand at a time, and then they're recasting the mortgage. So it's changing the payment quite a bit.
Mm-hmm.
And that extra payment amount that isn't getting stuck now in the 2x4s, because when you make a payment on your mortgage, you cannot use that money unless you refinance. So now that money, I think our payment started at like $2,600. We're down to about $1,200 now on the payment. So that extra money is going back towards the HELOC, building it up, and then going back towards another recast.
And that's actually called chunking.
Chunka, chunka.
All right, couple last questions here. So Paul is saying, so if I owed 300,000 left on a home and had 100,000 available on my HELOC, I put 100,000 of the HELOC towards the 300,000 and then run my W-2 pay into the HELOC. Just wrapping my head around this.
Yes and no. It just depends on how. If you're doing it like Devin, then yes. Then you would take the 100,000, put it down on the mortgage. This is called chunking, and then everything would go back into the HELOC. The mortgage payment would drop as soon as you acquired another 50,000, another 100,000 in the HELOC. That would go towards the mortgage again. But this is only because of the way that Devin is structured. So if you have a W-2. If we have 85% LTV, if you're at 45%, if you have a 700 credit score, we could do the all-in-one and take care of it all at once. So that would be a strategy call, Paul.
All right, love it. And we might be in the home stretch here. Doug is saying, does a HELOC give you a credit card, or how do you access the HELOC?
The HELOC is accessible through, yes, you get the
Basic bank account.
bank account.
Cool.
You just take money from the HELOC, move it right into the checking account, and use it. Money goes into the checking account, you move it back into the HELOC. That's all.
And then Cheryl is our last question right now, saying, is recast another term for financing?
No.
No. Oh, Okay. And then, sorry, this is our last question, I think, is James is saying, are there ways to use the one pot system without having a HELOC?
You can use your policy that way too.
Or a line of credit, a PLOC, personal line of credit too.
I was going to say,
Okay.
all you're thinking about is what the dollars are doing. You're
I mean-
trying to be efficient. Yeah.
Anything revolving, James. Anything revolving, you can utilize it this way.
Yeah.
All right. Well, that is a wrap right now, you guys. And if anybody wants to book a call with our team, it's mentors.beyourownbanker.com. Any last words, everybody?
Keep learning. Stick around the campfire. Keep learning.
I learned so much from you guys, like literally every day.
And that shows. This is why you guys need to keep coming to all the different things, because you never know what might click a different way or what might finally give you that aha moment to really, really understand it. So
It
please.
took me 16 months.
All right. Thanks, everybody.
All righty.
We're out.
See you guys.
Good job, guys.